Hello. Welcome back to the dojo. I am Sensei Kevlar. So glad to have you with me. Tonight we're covering what I call the dark arts, which is to say, weapons of mass portfolio destruction. What I mean by that is that there are products out there on exchanges that are designed to take your money and to do it really fast. So what we're going to do is we're going to do a deep dive into what the hell we're talking about here when we say the word derivative. I'm just going to bring out my notepad here. I want you to imagine with me for 1 minute that there is two people who are engaged in a regular trade. We'll say that there's a farmer, and he's producing milk. And there is a distributor, and he's buying milk, right? He's got cows that make milk. Okay. And the distributor has stores that buy milk. So what happens here is there's some price that happens on the open market in terms of what the farmer is going to get paid, per 100 gallons or whatever it is, whatever bulk unit it is that he's selling of his milk. And you know what this looks like. This looks like, them setting a price on the open market. And what happens is that this ends up being the bid side of the order books. On the distributor side, this looks like the same thing, except going in reverse. And what's happening here is these people are trying to buy milk at a better price, right? And when one of these prices matches the other one, a trade is made, and they disappear off the order book, and then the person buying gives the thing to the person... the person selling gives the thing to the person buying. The point is that in the future, the farmer might say, well, I kind of think that the price of $100 is pretty good for milk. In the future, I think there might be more milk available, and that could drive the price down. What I want to do is I want to lock in the price of $100 for in 6 months from now. On the other side, the distributor's saying, well, $100, man, this price could go up in the future. I want to make sure that I lock in a very specific opportunity here in terms of if that price goes up, I want to be able to buy the milk cheaply. Okay? So what they say is well, I'm going to go ahead and agree to, in 6 months, lock in a price of $100, right? And what they're doing is they're forming a contract, right? He is thinking that the price could go down and wants to lock in the price of $100 because that's a good sale price for him. He is thinking that the price could go up and he would have to pay more for milk. So he's locking in a price 6 months from now that will have him paying something that he believes will be a lower price. One of these people is right, and one of these people is wrong. Or, they're both right, and in 6 months from now, the price hasn't changed. That's the sort of binary outcome that results from this. Now, what happens is that later on, 6 months from now, the price has inevitably changed, okay? So maybe it's gone up to 105, and we've got, buyers all the way over here, all the way going up to 104, right? What we can see is that this person was wrong. He thought that he was making a good deal because the price was going to go down. He could have sold his milk for $105, but he's now obligated per his contract to sell at $100 because it's now 6 months down the line. On the other side here, this person was right. in order to buy milk on the open market, you're paying, 104, 105, but he's got a contract that locked it in for $100. What we can say here is that the contract itself is, for him, worth $5. And the reason for that is because the difference is $105 minus the $100 that he spent on it. Okay? On this side, this contract is at a deficit of $5. The reason for that is because he spent $100 on it, but really you could have gotten it for $105, which means that he is now negative $5. Over on this side, he is positive $5 on this contract. What we can do is we can say, well, if this person wants to sell this contract, maybe we're not 6 months out yet, we're 3 months out, and this contract is worth, potentially $5, but somebody's willing to pay $103 for it, even though we're at 105. Well, now what we're saying is that we can transfer ownership of this contract on this side, and he's made $2 on the sale, right? Or sorry, he's made $3 on the sale, rather, right? Because what he did is he sold it for 103. He bought it for 100, sold it for 103. It's being priced on the open market at 105. He made $3. The other guy picked up $2 worth of contract. Okay. Now on this side, nothing changed. They can sit here and do these swaps all day long. They can sit here and sell their contracts for their amount under or over the market value. They can sit here and sell their contracts under or over the market value on this side too. One of these sides represents a belief that the market is going to go down in the future. One of these sides represents a belief that the market is going to go up in the future. What exchanges do is they create these contracts based upon an existing market. Obviously, I'm not talking about milk. I'm talking about Bitcoin. And what they do is when one person takes up one side of the contract, the long side of the contract, and one person takes up the other side of the contract, the short side of the contract, this contract, this whole thing, poofs into existence. Didn't exist before, now it exists. Okay? And depending upon what the market is willing to take it off your hands for, this could represent a deficit or a profit from that sale. These are called futures, and the reason that they're called futures is because they are based upon a future delivery price. At some point, at some set point in the future, we are guaranteed that this contract will be delivered upon by this amount of product. Okay? In order to resolve this problem, what they do is they cancel out the contract and make you resolve how much you're either, given or taken. So what you do is you put your money in the contract. So you put your money in on one side or the other, the long side or the short. The other person puts his money in on the long side or the short, and the contract poofs into existence for the first time. Okay? Then somebody sells it or buys it off of you at a market price. Eventually what happens is that the expiration date of this contract arrives, and the amount that the amount that you bought it for minus or plus the amount that it's worth is what you get back. So if you're on the long side of the contract and the thing goes up, you make money. And if you're on the short side of the contract and the thing goes down, you make money. Now, since this is a binary option, a binary decision, either is going to go up or it's going to go down, we can further simplify this contract and they call these binary futures, right? in which you're just betting upon either the price going up or the price going down. This is just simply one person taking up one side of the contract and one person taking up the other side of the contract. We're poofing money into existence based upon an existing market, and its value is being valued by that market by a delivery in the future. Now, there's nothing inherently wrong with this. This is fine. Derivatives are a critical part of financial management. They are a good thing fundamentally. What I'm saying is that there's nothing wrong with futures. What happens is that in addition to having futures, what they do is they offer you what's called a margin on top of this. And what a margin is say that I want to, buy buy $100 worth of product, right? Normally what I would be doing, and what I've taught you to do, is we would be dollar cost averaging against that $100. We'd be setting up this plan and doing all these things. In a margin scenario, what you're doing is you're trying to multiply your buying power, and you're doing that by borrowing the money. So if you're doing 10x margin, the result is that you're borrowing $900, right? 900 borrowed plus the 100 original. Now you have $1,000 worth of buying power. Okay. So what happens is you put your $100 up and you get to buy $1,000 worth of product, Bitcoin in this case. More to the point, a future based upon the product, based upon the price of Bitcoin. So this product tends to follow the markets of Bitcoin. It tends to follow the markets it's derived from. Tends to, and I'll get to why it doesn't always in a minute here. Okay. The point is that you get to buy $1,000. Well, what happens when Bitcoin goes down 10%? Well, if you own $1,000 worth of Bitcoin and it loses 10% of its value, right? $1,000 minus 10% is equal to, you've got $900 left. Okay. Well, you now have a deficit of $100 owed. Okay. Well, guess what? That's what you went in with. What a 10% margin means is that if it goes down 10%, you lose 100% of what you went in for. Okay? It also means the inverse. It means that if it goes up 10%, you make 10 times as much as you otherwise would have, right? You actually make $100. So you can double your money that way if it goes up 10%. The problem is that you don't know when it's going to go up or down. This right here, this math right here, this is effectively equivalent to planning the trade and trading the plan, and then taking your starting position and multiplying it by 10. Because when the market moves against you, when your technical analysis fails, when the market does the opposite of what you have bet on, if you have gone long and then the market goes down, if you have gone short and then the market goes up, well, you're back to dollar cost averaging as a solution. You may as well have simply taken your plan, taken your starting number, and multiplied by 10, because it would have been the same thing. You would have done exactly the same effective thing when you ended up dollar cost averaging. You needed that much money anyway. The result is the same, because you end up, instead of spending $100, you're now spending $1,000. Look what happens when it goes up 10%. You make $100. The math is the same. The math is identical. What you've done is you've now put your whole bankroll at risk. And you've paid, in addition, this $900 that you borrowed right here, you paid a fee on that. It's called interest. The longer you borrow it for, the more interest you pay. So not only did you put your entire portfolio at risk of what's called a margin call when it goes against your position and you owe the entire amount that you've spent, and they'll just take it all from you, but you also owe a fee on top of that for borrowing the money. So it's not even $100, it's not even 10%, it's 9%, 9% and change or whatever the fee, plus the fee comes out to, right? So it's not even, this is even lower. A 9% change, well, Bitcoin does that today, and then tomorrow it'll do it again. This is how people lose their portfolios, is they get really, really heavily margined out, and then they get margin called, and they lose their whole portfolio. I don't recommend this. I highly, highly, highly suggest you instead plan the trade and trade the plan, and if you really want a 10x margin, well, simply 10x your starting amount. It's the same thing. 20x margin, 20x your starting amount. Okay. If you want to make money on this opportunity right here, this is a great opportunity because a lot of exchanges offer these types of opportunities. You want to be on the other side of this. This $900 that got borrowed, will somebody put up $900 worth of loan? And when that loan goes out, that goes out on a daily percentage rate. Okay? And when those markets get crazy, I've seen numbers, and I'm not saying that this is going to happen again anytime soon. This is back in 2017. But I've seen numbers as high as 4 and 5%. Okay? That's daily that people are paying to borrow the money. So what happens is you put up, X amount of money. It doesn't matter what it is, right? Doesn't have to be the whole $900. You can put out some amount, and then you're putting up that amount for a specific interest rate, and then people come and they do margin trading, short-long futures against short-long futures. They borrow your money and they pay you the interest rate. Here's where the real money is. If you want to make money on margins, be the lender. Don't be the guy getting the margin called. Be the guy who is loaning to the person who is getting the margin called and then has to pay off that loan, and you're making all the money, no matter what. Now, it isn't to say that there isn't risks associated with this. There's always risks associated with this, right? There are, depending upon what strategy the exchange uses in order to get you your money back, in order to pay off their loan, sometimes the exchange can end up with a loss. Sometimes, they can get so over margined, and then the margin call, the market can move so fast against them that they can't get margin called fast enough and liquidate their positions fast enough. The exchange can't take their money fast enough to get all your money back. That's risk. When you're doing this, that's risk. What sometimes they do is they socialize the losses. They say, okay, everybody gets a haircut. Everybody who was lending gets a big haircut, right? That's just money that you don't get back because that money is now lost. So there's always risks associated with this. There's risks anytime you put the money up on the exchange. But this is a smart move. And the reason that this is a smarter move is this has a whole lot less risk than this does. You want to calculate risk factor? That's an easy sell. Now, what happens is that whales understand this, and whales have already figured this out, and they're working with really, 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 really big portfolios. And they are, you know, going ahead and doing this and getting majorly dollar cost averaged out and making a lot of money sometimes doing that anyway. Sometimes they get margin called, sometimes they make a lot of money. A lot of the times what they're doing is they're manipulating the actual market that it's based upon. Let me show you what this looks like. Okay. I'm going to pull up a Bitcoin US dollar chart. What I'm then going to do is I'm going to add a comparison. I'm going to type BTC USD, but instead of going to just a regular market, instead what I'm going to go down to here is the 3-month forward. And I'm going to add this as a comparison. Why did that not work? Oh. For some reason that was the BTC USD. Okay, and then I want to add a comparison BTC USD 3M. Oh, I keep on doing it wrong. Hold on. Okay, and then... Ow. BTC USD. Okay. Then what I can do is I can add a comparison, and I'm going to add a symbol on the overlay of the main chart, BTC USD 3M. There we go. Okay. And what I'm going to do is I'm going to take that. I have to do a couple of things. First of all, I need to see, is this, yeah, so we've got a problem where when you why am I not able to... For some reason, I'm not getting... Let me just reload my page here, because I am not getting the normal behavior that I'm used to. I apologize. Just going to kill that. Okay, I've got BTC USD. I'm going to hit add, go BTC USD 3-month. Yeah, for some reason, okay. For some reason, I'm not getting the right style of information. What I'm trying to do is I'm trying to make a comparison, and for some reason, I'm not getting the two sides, the two price lines to sync up. So I can what I gotta do is I gotta manually get them to sync up myself, right? Where 4,000 on the right side is 4,000 on the left side, and 3,000 on the right side is 3,000 on the left side, okay? What I want to do is I want to take a look at what the relationship of one chart to the other one. I got to get them properly aligned here, okay? What happens here is there's a really heavy correlation between the two prices. And for some reason, I know what I can do. I can draw two lines. Okay, so this one is... Yeah, that's pretty close. Okay, so that's not close. I'm not sure what's going on here. Usually what I'm able to do is I'm able to come over here and change the style to be... I'm able to change this to... I'm able to link these two things together. Okay, So what you see when I... Oh, thank you. I appreciate that. Double click. There we go. Much better. Okay. What you see is you see a lot of situations where the correlation is strong, and you see a lot of situations where the correlation is anti-correlated, okay? A lot of the time, when the futures are above, or a price line that's above the thing that they're following, that's a sign that we're in a bullish market. A lot of the time when the futures are below, when they're pulling down on it like this, you see a lot of heavy correlation, okay? When they're right on top of, like this right here, that's usually a sign of a trend reversal incoming, okay? So what we're seeing here is, if you zoom in, and I'm just going to double click to make sure that we're looking at the same thing. Back here, futures were pulling down, but they were getting very heavily correlated. They were right on the line right for a while here, okay? Here they were pulling down, here they were pulling down. Now what we're seeing is a trend reversal. For whatever reason, the future traders are now working the futures in the opposite direction. And historically, when they have done this, this has been, you know, a worthwhile signal worth looking at, right? The heavier the correlation, the more the divergence, the stronger the signal that we might be headed up is, right? And what you see is, you see this a lot, especially in the past, in times right before. I'm just going to go out to a larger... Yeah, so you take a look at this. In times right before a major run up, you definitely see a lot of this, right? Right here, you see a lot of heavy correlation, and then futures diverged, and they stayed divergent for a while, right? During the time that the market was able to go down, the futures markets were heavily correlated. At the time at which the market was able to see volatility, the futures market was anti-correlated in one direction or another. Okay? This is yet another signal. This is yet another indicator of what the traders are actually doing, right? Of how they are planning their trades, of how they are working their analysis of what they believe is what is going to happen next, right? You know, and it's not to say that this is always the case. It's not to say that this is, you know, some sort of perfect you know, signal or anything. What I'm pointing out is this is further information that you include in your planning, right? What we can do is we can go back and we can back test this. We can say, you know, at the times at which the futures were above, was that a better time to be entering the market than when futures were below? And what I think you'll find is that there's a very heavy correlation, right? A very heavy correlation between market sentiment and the divergence, and including that fundamental analysis, including the understanding of what the market believes about where the market will go next, is a great way to optimize your plan. Doesn't eliminate the need for planning. What it does is it tells us times when we might see more volatility based upon market sentiment. What we're measuring is how the traders feel one direction or another, what they're betting on, what they're putting their money into. This is the wisdom of the crowds at work. There's plenty of prediction markets that are based upon this very idea. Augur, as it comes to mind, you know, as a crowdsourced prediction market. What we're doing is we're aggregating that information of the crowds, and we're trying to derive optimizations out of it, right? Would I be holding on to my, holding off on buying during a time like this and waiting for a real heavy correlation of it coming into line like this before doing my buying? Would I be, being real careful of something like this right here where we've got a real heavy divergence? Would I be seeing this and going, oh, look, this is what I've been waiting for, I've been waiting for, before we had all this divergence, and now we've got this real heavy correlation, and now we've got it going above. Can this be the time the turnaround that I've been waiting for? Right? Is this the double bottom? Is this really the end of the bull market? Or can it go lower? Can it come all the way down to here again? Based upon prior trends, based upon what the market sentiment is. Planning the trade and trading the plan means including as much information as possible, and then making sure that that information is valid and that your strategies are valid, have valid correlations to that information. Especially when you've got bad information like this, right? You got this thing completely falling out of line and not giving you a good reading of when things are going above and when things are going below. But when you do get it lined up, you can clearly see that here was a time we were going below. Here is a time when we are actually diverging above. Okay, so this is what I recommend with regards to futures, binary options, and margins. You want to make money off of them? Be the loaner. This is where the money gets made, loaning things out. And I'm not saying you're going to get this. Oftentimes you're going to get 0.001% daily or something really small. But during the hot markets, you can really take advantage of this, especially if you have automation, which allows you to do that. And there are definitely automation tools out there. It used to be that Poloniex had great tools for their lending. They got rid of that, but there are other tools out there, and I highly suggest you investigate diversification by creating daily interest. Come on, we've talked about 2%, 0.2%. I'll take 4 or 5% daily. This is easy. This is easy money right here. This is a great form of diversification. If you really want to do this, plan the trade, trade the plan. Take your starting position, multiply it by your margin. Now you've done the same thing. Okay. If you want to understand what the larger players are doing, make a comparison. Aggregate their information. Go and gather more information, right? More information looks like when are the futures expiring. There's countdown clocks, and if you look, you'll notice that there's oftentimes really heavily correlated motion between, the futures moving in one direction and the market moving in another direction in order to converge at the moment of the countdown. Kind of creates all kinds of fun market trends that are interesting to explore, right? So going and looking at the timing, going and looking at what the traders are doing, whether they have more longs than shorts. There's lots of information out there. And I really suggest that you share that information with other people. Let's get a discussion going about what we can find out about what the big players are doing. Here's information about what they're doing right here. We're looking at it. We don't have to spend anything to find out that this is wrong, that it's not going to go up, that it's going to come down to 34, 33, 32. I'm not saying that this is a magic bullet, that this is going to, always be the correct solution. What I'm saying is the more information that we can create in order to better inform the optimization of our planning the trade and trading the plan, the more money we can make together. And that is the way of the trader. So that will more or less conclude the theoretical aspects of the class. On Monday, what we're going to be doing is we're going to be taking everything that we have learned so far and actually applying it using automation, taking every bit of it and using it against a real portfolio, using real tools, real money, the real deal. I really hope to see you then. Thank you very much, everyone. Good night.